Welcome back to the New Zealand Property Insights. I'm Paul Roberts.
And I'm Debbie Roberts. We're the owners of Property Apprentice. And as always, we're here to help you navigate the New Zealand property market with real facts, not just headlines.
Today, we're opening with episode 20 and a look at some of the structural and fiscal adjustments underway as New Zealand's election campaign kicks off.
That's right. The start of the campaign has triggered an active debate about how property, wealth, and capital are taxed. We'll break down what the proposed capital gains tax rules mean for active buyers and sellers and examine the historical reality behind the popular belief that property values double every 10 years.
We'll also look at the latest inland revenue data showing substantial rise in KiwiSaver financial hardship applications as household budgets face continued pressure.
This episode's packed with practical, strategic insights to help you stay ahead of the crowd. So let's get into it. Segment number 1, the tax debate, looming capital gains tax, wealth tax exclusions, and banking levy adjustments. Kicking off this first segment with a look at the opening of New Zealand's election campaign. Yay! Which has ignited a significant debate over how property, wealth, and capital should be taxed. For property owners and mortgage advisors assisting clients with investment decisions, the proposed tax landscape is moving rapidly.
The clearest signal has come from the opposition, with Labour leader Chris Hipkins explicitly ruling out wealth and inheritance tax proposals of potential coalition partners, although he ruled out capital gains tax as well. Labour is also focusing on a narrow property tax policy, so let's lay out those exact facts. Chris Hipkins has officially ruled out implementing wealth taxes, inheritance taxes, or increased corporate taxes in any future Labour-led government. But those words there, future Labour-led government, is what they went back on with capital gains tax. So that capital gains tax is proposed at 28% on realised gains from residential and commercial properties, starting from what they're calling the valuation day, which is the 1st of July 2027. From that point forward, it will be taxed on any gain from that point, not grandfather, which explicitly excludes the family home currently. Revenue generated from this proposal of capital gains tax is intended to fund 3 free doctor's visits for New Zealanders annually. And more recently, it's also used to provide funding for maternity scans, free cervical screenings, and free prescriptions as well now.
The finance modelling for Labour's capital gains tax is based on conservative projections of 3 to 4% annual house price growth. The proposed capital gains tax would not be retrospective, meaning it would not apply to existing holdings or gains accrued before the implementation date of 1st of July 2027. However, it also relies on people selling properties for a profit. The Green Party's proposed tax package features a 2.5% annual wealth tax on net assets exceeding $10 million and a 33% inheritance tax on assets and gifts exceeding $1 million, which traps all of the farms in New Zealand, basically.
Yeah.
Under the Green Party's and most properties in Auckland, just saying. Under the Green Party's proposed inheritance tax, inherited investment properties would trigger a tax liability while family homes would remain exempt.
The Green Party had to correct an initial $800 million error in calculation in their policy costings, which they attributed to a topographical error.
The Green Party proposal also includes, and I shouldn't be laughing, but I can't help myself. The Green Party proposal also includes a new 45% top income tax rate for earnings above $160,000, alongside a $10,000 tax-free threshold. Now, I actually think having a tax-free threshold for low-income earners is a great idea. I'd argue that $10,000 is too small. I think the minimum tax threshold should be higher than that, but anyway, that's just my opinion. Under the confirmed budget 2026, a new prudential levy on banks, non-bank deposit takers and insurers is expected to raise $290 million over a 4-year period starting mid-2027, with costs likely passed through to mortgage interest rates.
Budget 2026 is also includes extending foreign investment fund revenue account method to all individuals to ease the tax burden on offshore share portfolios, alongside an additional $15 million a year for inland revenue, compliance and enforcement. This tax debate shows how crucial it is to separate the campaign rhetoric from practical reality. Chris Hipkins is making a clear distinction between a wealth tax and a capital gains tax is a strategic point. He noted a physical property has a practical advantage because unlike liquid financial assets, you cannot easily move physical buildings offshore to avoid taxation. For investors currently holding property, that tax is proposed, is not retrospective, and it's a major deal to note. This means that the gains accrued before July 2027 would remain untouched, drawing a clear boundary for existing portfolios.
And that's an important distinction to make. As we look at these proposals, we also have to consider the confirmed changes from Budget 2026, particularly that $290 million levy on banks and financial institutions. While the budget overall delivers smaller incremental adjustments rather than a structural overhaul, this banking levy is expected to directly affect borrowing costs. Financial institutions rarely absorb these operational fees. They're almost always passed down to borrowers through slightly higher mortgage rates. It highlights why working with an independent mortgage advisor is so critical to ensure the most favourable terms before these levies take effect.
Absolutely. So if we look at the Simplicity's chief economist, Shamabil, he comments that any capital gains tax decision needs to be politically enduring across cycles to bring stability. Lower, steadier house price growth actually is a stabilizing factor for the wider economy, and generic fear-mongering around election tax policies often does more harm than good.
Exactly. Rather than panicking over election year campaign proposals that might never even become law, look at the hard data, but still be careful who you vote for. We currently have an internationally competitive tax environment in New Zealand, especially with the full restoration of interest deductibility. Instead of sitting frozen on the sidelines, your focus right now should be on optimizing your current structures, maximizing your cash flow, and securing high quality assets while the wider market is quiet.
So one thing I have a bit of a concern with is what's mentioned in Labour's policy is they want the 3 doctors' visits and the cervical screening to be an immediate start and be funded straight after election. Now, election is November. So if they get voted in, and my question is, how are they going to pay for this? Because under their capital gains tax proposal, which comes into effect, don't forget, on the July 2027 valuation date, then there needs to be growth in properties. Then those properties that have made growth at that point then need to be sold. So if you think of somebody selling a property in July 2027, that it's going to be at least a few months before there's any growth. Then they've got to sell it. Then usually sort of 3 months before the property's settled, and they haven't made $1 at that point. So Labor have stated the costs for the Medicare, the doctor's visits and the screening is $550 million for the doctor's visits. Screening is $21.6 million. So come November 2026 to say November 2027, which is only a few months after that valuation day, where do they get $571.6 million with little or no capital gains tax by that point? They've also promised that they will go and look at the pay equity deal, which is $18.2 billion extra on top of that. So if you think as a voter that the capital gains tax won't be on your main home residence, regardless of whether you're an investor or a first home buyer and you're upgrading, or whoever you are, or your Sharesies account or your KiwiSaver, they are going to need the money. So it just won't work. I think the chances of having a full-blown capital gains tax across everything, shares, KiwiSaver, your residential home, everything is definitely going to happen under Labor government.
Otherwise, they're not going to be able to.
They can't afford it.
Yeah, exactly. So, and like Paul said earlier, don't forget that Chippy's the guy that said there'll be no capital gains tax under any government I lead. And here we are.
It's quite easy. It's hard to bring in a new tax. and it's easy to change that tax when it's in. That's the problem.
Absolutely. Absolutely. So you need to ask yourself, if you're thinking about voting for Labor, you need to ask yourself, can you trust the promises that they make in an election year? Segment number 2, the death of the 10-year doubling rule, historical growth cycles, shifted fundamentals, and properties on special.
So for our second topic today, we're addressing one of the most deep-seated beliefs in the New Zealand property market, the classic rule that property house prices automatically double every 10 years.
New data and historical analysis shows that the 2020s is actually shaping up to be the decade with the weakest house price growth in the past 70 years. Although, to be fair, that's starting at a point where we had a massive downgrade in house prices in late 2021. So, we're starting behind the 8 ball here anyway, and it's been a flat market ever since. But we're going to examine whether this long-held doubling rule is officially broken and what a slower growth environment might mean for modern property strategies. So let's have a look directly at the facts. Historical analysis reveals that the 2020s is on track to become the decade with the weakest residential price growth recorded in New Zealand over the past 70 years. Although we do still have a solid 4 years left, don't we?
Yep.
So we'll see what happens in the next 4 years. While New Zealanders are frequently told that residential properties double in value every 10 years, it's not a rule, right? House prices in the 2020s so far have grown by approximately 10% so far.
So historical decade-on-decade house prices increases show that growth of 147% in the 1950s, 53% in the 1960s, 230% in the 70s, 259% in the 1980s, 45% in the 1990s, 107% in the 2000s, and 113% in the 2010s. Only the 1960s and the 1990s experienced similar growth rates, with nominal values rising about 53% and 45% respectively over those 10-year periods.
Analysis of data since 1950 reveals 260 overlapping 10-year periods, with nominal house prices doubling or more in 143 of those periods. So that means that occurs about 55% of the time, more than half, to be fair. During high inflation decades like the 1970s and 1980s, nominal values rose rapidly, but the real inflation-adjusted data of housing actually fell.
Core factors that historically drove the doubling of house prices include a long-term downward trend in interest rates, the transitional to dual-income households, constrained land supply, and a favourable property tax system. Economists doubt these historical growth drivers will apply moving forward because interest rates have already bottomed out. Political policy is focused on boosting land supply, and the tax framework is becoming more restrictive, and most households have already maximised their dual income potential.
A reduction in the long-run average capital growth rate from 6 or 7% down to a more normal 4 or 5% means properties will still double, but the timeline could extend to about 18 years if it was a 4% growth rate per year on average. Experienced property investors note that market cycles are often forgotten, with buyers assuming booms will last forever during upswings and believing that recessions will never end during downturns. The current market slowdown represents a normal phase in the property cycle, indicating that the recovery is already underway, with many properties currently selling at discounted prices that are likely to rise over the medium term.
Analysis from Gareth Turnman is a fantastic reality check. That old trope that property automatically doubles in values every 10 years is actually only true for about 55% of the time since the 1950s. And when you look at the 2020s so far, with only a 10% lift over the last 6 years, that's clear that we're in a different phase of the property cycle, or we're on the brink of a mother of all booms. The historical drivers of rapid growth, like interest rates dropping from double digits down to record lows and substantial transition to double income households, appear to be the thing of the past. However, when we consider that interest rates are still historically low levels And now that the economy is improving, it will not be long before employment levels start to improve. And it does make you wonder.
Exactly. Calvin Davidson makes a point that if we accept a lower long-term capital growth rate of 4 or 5%, the time it takes for property to double in value stretches out to about 18 years. And this is why buying property based on raw emotion or the lazy assumption of capital gains being automatic and doubling every 10 years can be quite dangerous. At the moment, it means the cycles are playing out just how they always have. When the crowd thinks it's not a great time to buy, this is when we often see the best deals being made. You can literally create your own capital growth by buying below value and adding value to properties. And we are very firmly still in a buyer's market.
During a boom, when the block is on TV, everyone thinks house prices will rise forever. And during a downturn, they think it will never recover. They get distracted by new toys like digital share platforms and forget the underlying fundamentals of real estate have actually not changed. People need a physical place to live, and land in our major centres remains structurally limited.
Absolutely. And for smart buyers, the fact that property values are flat means that most high quality listings on the market today are essentially on special. You're buying below intrinsic value in a quiet market, which allows you, like I said before, to manufacture your own capital gains at the point of purchase. Slow and long-term growth, if that happens, simply means that you have to be far more strategic with the properties that you're purchasing. You need to focus on the fundamentals like local tenant demand, strong rental returns, and securing assets that make financial sense on the day you buy them, not just relying on future capital growth to give you the results. Now, does that mean that we think that the 10-year rule, which has never actually been a rule, it's just a general rule of thumb, because house prices have historically tended to average out doubling about once every 10 years. Like if you look at the peak of one boom to the peak of the next, it's about 10 years. So does that mean that we think that that's changed? No, it just means this has been a long correction period, the second longest since the early 70s. It doesn't mean house prices aren't going to pick up again. And I think with the underlying demand, there's a really strong chance that when things do get back to more normal times, as far as certainty goes, we could be on the brink of a mother of all booms.
And I have noticed a lot of contact from Australian investors looking to buy here with exactly what the Labor government is doing in Australia.
Exactly. So segment 3 for this New Zealand Property Insights, we've got the KiwiSaver squeeze, rising hardship withdrawals, onerous bureaucracy, there's a tongue twister, and the whole of life savings debate. For our final segment today, let's talk about this, the rising financial pressure being felt by everyday New Zealanders. New figures from the Inland Revenue reveal that a growing number of KiwiSaver members are turning to their retirement savings early to get themselves out of severe financial hardship.
It's a sobering trend that shows the real world impacts of economic current cycle on household budgets. One organisation handling these applications is warning that people must understand the strict requirements and look at other options first. So let's look directly at those facts. Inland Revenue data shows about 5,090 KiwiSaver members withdrew their savings due to financial hardship in May, representing an increase from the 4,940 hardship withdrawals in May 2025, a year earlier.
But not a massive increase, but still an increase. 4,940 up to 5,090. It is still an increase. The total amount withdrawn due to financial hardship in May reached $43.9 million, which represents a minor decrease from the $44.2 million withdrawn during the same month last year. In other words, more people withdrew their KiwiSaver for financial hardship reasons, but they withdrew less than last year.
David Callaghan, Public Trust General Manager of Trustee Services, reports that while application volumes are increasing year on year, the average individual withdrawal amount has remained stable at between $8,500 to $9,000. Hardship applications volumes across the KiwiSaver industry exceeded 58,000 in 2025, represented a doubling of applications compared to the volume recorded just 2 years prior. During the first 5 months of 2026, inland revenue data shows approximately 24,500 financial hardship applications, representing an increase from the 22,000 applications recorded in the same period last year.
Simplicity economist Shima Bilyaki notes that the average withdrawal size is maxed out, representing the maximum 13-week financial assistance amount that members can legally claim. DebtFix received 456 referrals from KiwiSaver providers in May. That was up from 400 last year, with successful withdrawals rising to 221 from the 123 withdrawals recorded last year. The hardship withdrawal rules legally require applicants to exhaust all other options first, including formally requesting lenders for hardship accommodations on any existing mortgages, which lenders are legally required to consider for unforeseen hardship.
Due to this strict criteria, some stressed individuals are choosing to switch KiwiSaver provider to find companies with a less onerous application process. Equab suggests that if KiwiSavers were ever made compulsory, access rules would need to be eased, proposing that New Zealand look towards the Singapore model of whole life savings, which allows members to borrow or withdraw funds for healthcare, education, and business setups. I think that you should be able to use your KiwiSaver to withdraw if you want to buy an investment property, if you can't afford to buy your first home where you live. If Auckland's too unaffordable for you, or you live in Queenstown and it's really unaffordable for you, you should be able to be allowed to use that to buy investment property.
Absolutely. So that would still mean that you'd need to qualify for that first home withdrawal. But the difference would be you could use that first home KiwiSaver withdrawal to buy a home or an investment property. It'd at least get your foot on the property ladder and make it a bit easier for the people who live in areas where it's unaffordable for them to buy something to live in.
These figures are quite eye-opening, and look at the pressure on household budgets right now. We're seeing hardship applications double in 2 years to exceed 58,000, shows that many Kiwis are reaching their absolute limit.
It's an incredibly difficult hurdle, but we've got to look at the long-term impact. If you pull out $8,500 or $9,000 from your KiwiSaver, it might solve an immediate 13-week emergency. But if you don't make plans to increase your contributions after you get back on top of things financially, it can severely derail your long-term retirement planning and wealth accumulation plan, which is also exactly what would happen if you were allowed to withdraw your KiwiSaver funds for any other life hurdles that came about.
So this core debate from Shamabil points out that Singapore's whole life saving model is very interesting. If KiwiSaver were treated as a life saving scheme where you could access capital for health, education, starting a business, maybe even investment property, it could completely change how Kiwis view and interact with their savings. It shifts the asset class from a locked retirement fund into a strategic tool to manage your life cycles. And I think that if we look at all the commentary from all the political parties around retirement age, and does it need to go up? And at some point we need to look into this because it's not going to be affordable. If you're not using that money or you're taking it out, and like Debbie said, you're not reinvesting that money back in, it's not going to be there for people that are, I think, 20 years, 10 years away from retirement.
And I think this is the problem that we're facing when we're talking about making decisions like this. Some people could quite happily withdraw the money before retirement and work out a plan to reimburse it so that their retirement fund would still be in place. Whereas others would just take out money whenever they needed some extra and they wouldn't fix the fundamental problems of cash flow management. So it's a really difficult decision to enable something like that to be modified, and it would be a significant structural shift. In our current environment where these whole of life options don't exist, relying on KiwiSaver as your only safety net is highly risky. And that's why we teach our clients about building independent, cash flowing property portfolios. Real financial security means creating multiple streams of income that you can control as much as possible anyway. So you never find yourself in a position where you have to jump through onerous bureaucratic hoops just to access your own savings during a downturn.
And unfortunately, it isn't something we can tax our way out of. It's something that needs to change fundamentally, and people need to take responsibility for their own future. So that wraps up this episode 20 of New Zealand Property Insights. We've analysed the shifting tax policy landscape, its direct impact on borrowing costs, and its historical realities of 70-year price growth cycles, and the practical realities of KiwiSaver hardship pressures.
If looking at these long-term structural changes has made you think that you might need a personalised financial plan, or if you want to understand how to build your own buying rules in a changing market, our team's here ready to help.
We also invite you to come to one of our free online educational sessions called How to Succeed with Property Investing. It's highly practical, data-backed session designed to show you how to establish your buying boundaries, maximize your borrowing capacity safely, and evaluate changing regional demand. And it's held with Debbie.
Online and free. And to be clear, there's no such thing as risk-free investing. So, doesn't matter which vehicle you're looking at, no such thing. But with our free events, there's no sales pressure, zero obligation to purchase anything because our company doesn't sell property. We focus on improving your knowledge and implementing the strategy that's best for your financial position. You can find the registration link directly in the show notes or go to propertyapprentice.co.nz to secure your spot today.
Thanks for listening.
Tune in next time. Hey there, want to stay on top of the latest property news and trends? Subscribe to the Property Apprentice podcast for weekly updates that will help you to navigate the market like a pro. We cover everything from insider tips to expert interviews, so you'll always be in the know. And don't forget to ring the bell and hit that subscribe button here on our YouTube channel for even more helpful content to boost your property journey. Check out the link in the description to subscribe to the podcast, and we'll see you in the next episode. Happy investing.